Hello everyone, welcome to another edition of our Macro and Market Moves, and we have our Head of Research and Strategist, Mr. Seshadri Sen. So let's start with the question, sir. In Emkay latest strategy report, we have seen BFSI weightage halved from 30 to 15%. Could you shed light on this?
Thank you for the question. So we've been underweight on financials for a while, and in our latest note, we've downgraded our position in from a BFSI even further. The reason for the incremental trigger is the aggressive action taken by the RBI against various lenders, which we think will have an impact on growth and risk taking in the private sector lenders for the next 2-3 years. Our overall underweight view on financials is underpinned by three factors. First, we think growth is challenged as we are entering into a period where demand for credit will not accelerate from where we are. Private sector lenders are unable to gain market share at the pace that they used to in the early 2000s. Secondly, as far as profitability is concerned, the avenues for supernormal returns is narrowing for the banks, and therefore we think that return on assets and NIMs will structurally be under pressure. Finally, most importantly, we think valuations for these private sector lenders are not reflecting this changed scenario where both growth and profitability are challenged. We think that the fair value of the banks are between 1.5 to 1.7, where they are actually trading well above 2 in most cases. We therefore recommend that investors cut their weightage on BFSI and reallocate them to manufacturing and infrastructure sectors.
Moving to next, which sector do you feel would be doing extremely well in next couple of years?
Fundamentally, it will be manufacturing, capital goods, infrastructure, consumer durables. These are the segments which we think will do very well for the next 2 years. There are valuation challenges within these sectors, so we will be selective in the stocks that we pick in these sectors. But as in terms of fundamentals and momentum and earnings growth, these are the sectors which stand out.
Sure. In your latest India strategy report, you mentioned that your focus remains on large and or mid cap only. Could you explain rational behavior behind this particular approach?
The model portfolio is actually focused on large and mid cap because the target audience of large fund managers, if you're running large amount of funds, it is not possible to take large significant exposures in small caps. As a theme, we do prefer mid and small caps. So we've said repeatedly that SMIDs, which is small and mid cap reports, sectors, they will continue to outperform large caps over the medium term. The reason is that the sectors which are doing well, which I just mentioned, manufacturing, infrastructure, capital goods, they are largely populated by small and mid-cap companies, and therefore we think from a bottom-up perspective, small and mid-cap companies will continue to outperform. The warning though is that there are pockets of overvaluation in these segments, and we know that there are much more significant liquidity risks here. So investors should be careful about which stocks they pick. But overall, as a theme, we continue to prefer small and mid caps.
Sure. There is a lot of optimism around India's defense sector. What are the views on the same?
We don't cover defense yet. The optimism is very justified. We are in a structurally changing environment in defense, where there's continued spending as we grow as an economy. The national security needs are going up, and this government has pursued an aggressive policy of trying to localize as much of that manufacturing as possible. This has thrown up exponential growth opportunities for many defense companies. We don't cover them, and therefore we would still advise investors to be a little careful on valuations in this segment. We will have more once our formal coverage starts.
Sure. Do you think FMGC are on track to be back on their pre-COVID momentum?
We've been underweight FMCG for a while, but when we started our model portfolio in January, we said that maybe this is a time to keep some FMCG companies in the radar because mass segment spending has been lackluster since COVID, and at some stage it would turn around. We were getting our cues from the motorcycle market, where entry-level two-wheelers have started to do well for the past 6-8 months. In the recent past, we've seen some companies catering to this mass segment, FMCG and some mass retailers, starting to report better numbers. So we would still say keep an eye out and selectively take exposure in this segment. Sometimes these can be falls down, so keep watching the segment, but we are incrementally looking a little more positive on FMCG. The more medium-term challenges remain that the valuations are overextended a little bit in many cases. But if there is a turnaround and ROCEs start to improve, then we think valuations will bottom out at that stage.
Sure. What is your advice to investors who are looking to invest this year? What pockets should they look for?
As I said, markets have done very well. So be moderate in return expectations from here. That would be the first lesson, that you don't look into the rear view mirror and expect this kind of market performance to continue year in, year out. As far as sectors is concerned, we still maintain that continue to focus on manufacturing sectors, which would from a sectoral perspective be materials, capital goods, industrials, consumer durables. These would be the sectors that would continue to outperform. Selectively continue to look at small and mid caps, because from a medium term perspective there will be more outperformance opportunities there. But we are sitting on the crest of a wave, and therefore be careful, invest slowly and wisely, and keep risk management in mind at all stages.
In light of current economic climate, what are the key growth drivers for IT sectors, and how do you see trends in digital transformation and cloud adopting impacting the revenue streams of major IT firms?
I think the digital and the cloud adoption will continue, but the major delta that had to come from those trends have already come in. Of course, IT is facing cyclical challenges because the US economy has slowed down in the recent past, and we think that until the US economy starts to accelerate, this cyclical turnaround will not happen. There is a larger structural question of whether generative AI could actually seriously disrupt the business of the Indian IT services companies. I think the jury is still out on that, and one will have to sit and wait and watch. The time to buy IT is when valuations are at rock bottom, because in any scenario they don't deliver very strong earnings compounding. So the majority of the money is made by re-rating, so one has to wait patiently for the right valuations to emerge. At this point in time, we are a little underweight IT. We would prefer to wait for a while and see visibility on the turnaround and then relook at the sector.
So quick rapid fire, you can comment whether it is bullish or bearish. Consumer goods?
Neutral.
Healthcare?
Bullish.
Logistics?
Bullish.
IT sectors?
Bearish.
Automobiles?
Bullish.
Banking?
Bearish.
Thank you so much, guys. Thank you so much, Mr. Seshadri. So, guys, please do like, share and subscribe our channel.